very exciting. It's very exciting. Okay, here we are. Thank you so much, Dan. You are watching Bakersfield Realtor. We are here with Dan Ardis with San Joaquin Valley Mortgage.
Hello.
The man in charge, yes. And we are going to be talking today about the difference between, because Dan is he and I are working together right now on a couple of buyers that have FHA loans. So we thought, let's discuss it. So
yes, so we have big breaking news, everybody. Big breaking news.
I'm so excited.
Okay, big breaking news. Ready?
Yes.
FHA just lowered their mortgage insurance premiums.
What? Okay.
By quite a bit too. By quite a bit.
Okay, break that down.
Okay, so overall, the last 2 or 3 years or so, FHA has been gathering quite a bit of money into their coffers for their mortgage insurance program, basically. Okay. They have more money than they really need to have at this point for that purpose. Okay. So they finally have, after a lot of pressure for the last about 1.5 years from us, have finally lowered it down. So it was 0.85% per year. It is now 0.55% per year.
That's significant.
And the big breaking news is I can offer that now.
Oh, it's like effectively immediately.
Yeah. So the thing is it's technically it's supposed to be for FHA case numbers pulled after March 20th, but I can honor it now for anything closing as of Monday.
So tell me how that would look on somebody that's trying to qualify for maybe a $400,000 house. What does that look like?
Yeah. So for our clients that we're talking about, right?
Yeah.
They're going to save over $100 a month just because of that. Oh my God. So here's the thing in Bakersfield, okay, on average, if you're in the 400-ish range or so, just that change alone gave about $17,000 more purchasing power. So in other words, somebody can qualify for $17,000 more because their debt to income ratio is exactly the same.
Because that number is now down.
Yeah.
Oh my gosh, that's huge.
Pretty awesome. Yeah, it's pretty cool.
And where?
So that's the big breaking news that happened, a few minutes ago, right? And I was like, oh, I'm saving it for the show.
Why did this happen? I cannot wait to tell my buyers that we're working with right now. I cannot wait to call them. But why did this happen? Like they just suddenly let's check the numbers. Like how did that come to be?
Well, this is it was getting out of hand with like how much money they had set aside. They don't need that much. Okay. These loans perform really well still.
Okay.
So there's not a lot of defaulting going on to where they're having to, pay out a bunch of mortgage insurance money, right?
Okay.
And I don't know, maybe people don't even understand what mortgage insurance is. Mortgage insurance is insurance for the lender against default. Okay. Risk. So it's insurance so that if you foreclose, the lender may not lose their shirt quite as bad because the insurance company will kick in some of the money instead of just completely losing all of it, right? You see what I'm saying?
And and mortgage insurance is pretty part and parcel with an FHA loan.
Always, yeah. So there's always mortgage insurance on FHA loans. It varies a little bit depending on your down payment. Right, so we can go over that actually really quick if you want. I can share my screen and show you that.
Do it.
Okay, so let me do that.
Make sure you're shareable.
One moment.
Sure. Okay, I'm going to add it. There you go. Okay. Take it away.
All right. So here, this is the one we want to focus on right here. And you'll see my kiddos in the background there in a minute.
That's right.
But it's cool. It's cool.
They're cute.
They're the reason I do this. So there you go. All right. So here we go. So this one is the one to focus on right here. Okay.
Okay.
Right. All right. So that's the one we want to focus on. So that's the one that most people are doing is more than 95% loan to value. So most FHA people are putting 3.5% down, which would fall in this category. Okay?
Right.
So in that case, only 55 basis points, so 0.55% per year, split out over 12, and that's what your monthly payment is, right? So that's a lot better than 0.85. So that's a pretty big deal.
That is significant.
Yeah. So then if you look at the other ones, you can see if you put somewhere between 5 and 10% down, right? I know this is weird, but I'll make it easy. Anywhere between 5 and 10% down is only 50 then. It's a smidge better, and that's how it's always been.
Okay.
Right? And then if you do more than 10% down, it's 50, but it actually ends after 11 years.
Oh, wow. That's big. They don't usually.
So all the other ones, FHA, for the most part, it's always been forever. Like you always are going to have, but in this case, you'd be gone after 11 years. Now, here's the thing. With FHA loans, you're probably not going to have it for a full 11 years. The idea with FHA is you're going to want to get out of this mortgage insurance as soon as possible.
Right.
Okay. So when you've built up your equity all the way to 80% loan to value, so when you've paid it down to where you only owe 80% of what the house is worth.
Right.
And when I say what the house is worth, that's what you started with. That's when your initial loan happened, is the 80%. Okay. When you get to that 80%, typically the mortgage insurance would go away on its own on a conventional loan. Okay. So when you're there on an FHA, it's time to refi because you want to get over to the conventional side so that you don't have mortgage insurance at all. Right. Because in this case, our borrowers, it's somewhere around $300 a month with the 0.85. Okay. I'm saying it's a lot. It's a good chunk of money. So you want to let it, kind of give you the kick in the butt to, build your credit back up, get your credit in a better place, get your finances in order, that's use it as motivation, right? That's kind of what I tell my folks, when you're putting a loan together with somebody, the idea is I'm looking, years into the future. Like, how is this loan going to affect the next loan we do? Right. Because most people that are doing loans right now are going to refi in the next 2 or 3 years at some point. They should. The rates are supposed to come back down. They always do in a recession. So we're heading into one. So hopefully, these people won't have these loans very long. That's the idea there.
And to that point about the refining. So when they go to refi and adjust their rate, do they have to refi FHA to conventional? Does anybody ever go conventional to FHA when they refi?
They could technically if it made sense. The idea there, though, is you're probably adding a lot more mortgage insurance, so your savings monthly wouldn't necessarily be there. It also depends on the purpose. If you're trying to cash out, maybe you have a ton of equity, but you need to cash out, and you've had a credit event recently, a foreclosure, or a bankruptcy or something like that. Right. The window of opportunity is much shorter for FHA versus conventional. So we can talk about that too if you want. Go for it, Dan. Timelines there. I'm just going to go. I don't know about you. I'm just going to go. Okay. No. I drank some tea before this. I'm ready to go. Okay. All right. So I'm going to show you this really quick. So I got to make sure I'm showing the right screen here. Okay. So hopefully this is big enough, but I will make it a little bit bigger. How's that sound? Okay. Sure. So you want to focus right around in here. Okay.
What is this document that I'm looking at?
Okay, so this is showing you this is a seasoning chart showing how long you have to wait after certain events in order to get certain types of loans. Okay.
So a life event that you explained earlier, a life event.
Exactly. So you'll see the life events at the top here. So foreclosure, short sale, Chapter 7 bankruptcy, Chapter 13 bankruptcy. Okay. And then on this side is the loan types. Okay. So Fannie Mae, Freddie Mac, those are your conventional loans. Okay. Then there's FHA right here, and then you've got the VA in the middle. Bottom. Yeah. Okay. So for example, if you've had a foreclosure event in the past, okay, if you are 7 years beyond the discharge date, okay, so we'll ask for bankruptcy paperwork in that case, and we get, it shows the stamp that shows the discharge date from the court. Okay. So in that case, if it's 7 years removed from that, then you can do a conventional loan again. Okay. If you go FHA, though, you only have to wait 3 years. Nice. So that's another reason why people may choose FHA versus conventional, or that FHA may make more sense than conventional. Okay. Yeah. So conventional is a little more strict. FHA is backed by the government. So the government helps these folks get into homes, even though their credit may not be as good. Right. Okay. Also, that whole mortgage insurance thing plays a part in this. So, you are paying for some of the risk alleviation, if you will. Okay. So that's how you're helping with that part of it. Okay. Anyway, so that's another part of FHA versus conventional that may make you go one way or the other. This is why you need a loan officer to kind of help put you in the right spot, because there's a lot of parts to why we would choose one versus the other. Now, to that point,
not only with the life events, but don't the interest rates make a difference on why some people choose FHA over conventional, taking aside how much money they're putting it down?
So here's the thing. Okay. The other big part, so there's really kind of three things that we look at when choosing between FHA or conventional.
Okay.
So one is going to be life events, right? So, figuring that part out for how long we have seasoned beyond these certain life events.
Mm-hmm.
Monthly payment is also another really big one.
Right.
Okay. So monthly payment is going to take into account mortgage insurance and your interest rate. So, for example, our mutual clients, right? They're in an FHA loan because it's their least monthly payment. So that's make more sense, because really, you can have people care about interest rates and all that kind of stuff, but really all they care about is the monthly payment. Like, the monthly payment is the most important thing. That's why they even care about the rates, right? Because they want the lowest monthly payment. So that's where you want, that's another thing. And then the third thing, as far as FHA goes, is sorry, my phone just buzzed. Somebody wants to talk to me. The third thing is really the mortgage insurance. So the mortgage insurance is a big factor because one goes away, one doesn't.
Right. So they can afford the payment, then they have to factor in the mortgage insurance.
Yeah.
Those two never leave each other, like you were mentioning before.
Look into the future too, right?
Yeah.
Mm-hmm.
So if they're looking at, is this their forever home?
Right.
Or is this the home that's going to get them to their forever home? That's also something to consider, because FHA, in my experience, has generally been a lot of my first-time buyers.
Sure.
Because they haven't saved 20 to 30% like a lot of conventional. And
Let me get into that a little bit. So that's the thing, is that really should have been number 3. Actually, you're reminding me, I think, of what number 3 should have been. So down payment is the big part of it too.
Right.
And debt to income ratio is
right
too. So down payment wise, FHA's minimum is 3.5%. Okay. So the minimum on conventional is 3%. So it's a little bit less, but at the same time, when you do a 3% down, now this is kind of Uncle Dan talking. Okay. This is me saying, hey, okay, I would go 5% down if I could, because 3% down, the mortgage insurance is bad, the rates aren't as good. For the extra 2% really down, just try to go the 5%. It's just a better loan, better scenario.
Right.
It works for some people, but really it's not very good. So 3.5% down though is like really great rates for FHA. So, the 0.5% extra is worth it a lot of the time.
I agree.
So that's another reason why we would come and say, hey, go FHA, because you've got this certain amount of money in the bank and you could make this house happen with FHA.
Right.
As far as all the cash you need to close.
Right. And so when they move from what would presumably be their starter house to their forever house, they don't have to stay FHA because they're going to presumably have proceeds toward the next house. But they could also stay FHA if they don't want to use up all the proceeds on the purchase. Yes. But if they are trying to buy like a fixer-upper, that's not something we want the FHA on. Because why?
Right. So FHA has much more stringent health and safety standards. Okay.
So FHA, a lot of times, right? It really kind of freaks them out.
Yeah. So HUD is trying to.
Who's HUD? I know who HUD is, but
Housing and Urban Development Department, right?
And are they cousins?
They're the umbrella over FHA. Okay. So HUD uses the product, or the FHA, uses FHA in a way, in this sense, to help keep the base level of the housing inventory somewhat updated. Okay. And so they have different rules if you're going to get an FHA loan that mandate health and safety related things. So I can go into kind of what those are going to be.
Okay. So but before you do that, go ahead. So FHA is more stringent for the buyer, not the seller, right?
Both.
Okay. Now go into it.
So both, yeah. So the idea there is that with with FHA, they want to see health and safety standards. So they're going to be looking for things like visible mold, right? Because of inhalation problems. They're going to be looking for peeling paint if the home was built before the 70s. Okay.
78.
Because there was lead in paint back then, right? There was lead in paint. So you could inhale the lead, right?
Earth defects, all the things. Yep.
Broken subfloors, missing handrails on staircases, missing heater or air conditioner. Those could be health related problems if you're if you're too cold or too hot, right?
Now, a conventional loan, you're saying, and I know this, but I'm explaining this to the people that might be like, a conventional loan doesn't care about railing missing.
They do, they do. But FHA is more is going to be more stringent on a lot of those things than a conventional side. So you have to be an FHA appraiser has to have specific training and licensing to be able to do FHA appraisals. Okay. Because there's different things they're looking for.
Okay.
Okay. So anyway, so there's differences there too, because we would choose FHA versus conventional depending on the status of the house that we're trying to buy.
Right.
So if we're trying to buy something that's a little bit more of a fixer-upper, well, we're going to need to lean conventional in that case.
Because we're going to get a pass on some of the things. We can't say that M word, by the way. We have to be like dark substance. We can't even say mold. Dark discoloration. Right. But so not that conventional lenders don't care, but they don't hold it to the same standard that an FHA is going to do. And yes, conventional cares about that, but not at the same level that FHA. And do those, and then back to the appraisal, that appraisal, explain how somebody that might not understand how that appraisal stays with the property.
Yes. So FHA appraisals are so basically when you start an FHA loan, you pull what's called an FHA case number. Okay. So the FHA case number is your permission, I suppose, to start an FHA loan. Okay. So all the paperwork in the file has the FHA case number, including the appraisal. Okay. Right. So the FHA, so once you do an FHA loan, okay, let's just say that FHA loan goes till 20 days in and the whole deal blows up because maybe there was something in the inspection that the buyer didn't like. It was, bad shape or bad roof or who knows. They're just like, no, I'm out. So they cancel. But the appraisal was done. Okay. So FHA, that appraisal is going to follow the house.
For how long?
For 120 days, I believe. I think it's 120 days. Anyway, so it'll actually maybe 6 months. I don't remember. But it follows the house for sure. Okay. So what happens is the next person that comes to buy the house, if they are doing FHA as well, then FHA will advise them there is already a case number on this house. And then what happens is that new person pays for the appraisal and the first person gets reimbursed. Oh. Back for what they paid. So it follows the house. Whoever uses it.
If buyer number one cancels and they've already gotten the appraisal and then they cancel, buyer number two still is.
One is FHA.
Yep. Presumably they're both FHA. Buyer number two goes forward and it says, okay, your appraisal came in. They have to get another one and ta-da, it's going to come up with the same number. Buyer number one gets their money back.
Yes.
That's news to me.
Yep.
I don't think I've ever gotten into that scenario. But
because the thing is the person that's going to pay for it is the one that closes a loan with it.
Got it.
Okay. So I've had clients get reimbursed when they had a canceled appraisal and we were like, yay, somebody did FHA after us, Wow. And then, we get to call them a couple months later and say, hey, you're getting a refund.
Just That's awesome. I never knew that. Yeah. I did. Okay. I'm checking my notes here. Okay. So for a seller.
Yeah.
Right. So a seller wants the appraisal. They always want it high, right? And we realtors, we try and get that right between like what we think it's going to appraise for versus what it can sell for. We try and get those as close as we can. But can you have an FHA buyer turn to a conventional buyer at some point? Is it before the appraisal? Is it after? How does that work?
Right. Okay. So you technically could be an escrow and swap. Okay. So I have swapped.
That makes me nervous. Like I've got a lot in escrow and I'm thinking, I don't want them to change. I don't want them to change.
Technically you can't. Now there's a big, asterisk on that. Okay.
Right.
So you technically can swap. I have had folks where they jump in conventional, something changes and they need to go FHA now to qualify. I've had it happen. It's just another day in real estate. You never know. I'm just, real estate is its own thing. Okay. I'm never surprised anymore. So sometimes if that happens, the big asterisk that I would have is the appraisal part. So if the appraisal's been done, FHA appraisals are different than conventional ones, right? So they're not just going to be either way. You can't just take one to the other, right?
Is that why a seller would deny a buyer that's an FHA because they want to make sure that the appraisal isn't stringent, even if the house is in good condition? Again, those clients that we're working with right now,
it's unfortunate because it's really it's sadly a kind of a lack of education potentially for the buyer. Like I feel like the agents get it now, the real estate agents get it. But the sellers are still a little bit panicked, thinking that like, oh, I'm going to have to spend so much more money if I do FHA, and it's going to come in low, or they're going to hate my house and they're going to pick it apart and all this kind of stuff, right? Not necessarily. That's not really what we see realistically.
Because you can't really, we can't really advise here, pick this buyer because they're conventional, or here, pick this buyer because they're FHA. But to your point, we have to educate them, like whatever the status of the house. If it's the back end of a dump truck kind of a house, then we don't want them picking like an FHA buyer. But if it's in good shape and the homeowners have done, then it's not going to make a difference because everything else is going to come out in the wash anyway.
The overarching thing is FHA loans are good loans.
They are.
They meet people where they're at. They give
it used to be substandard, like how VA and FHA, they were kind of below conventional, but I think that's kind of leveled out a little bit, don't you think?
Yeah, and that's the thing is when somebody comes with a conventional offer, that they have a good credit score, right? But it doesn't necessarily, like FHA, for example, the buyer that we're talking about, it's only FHA because one of them has a lower credit score, the other one's got like a 780 credit score.
Right.
They just needed to go that route, so they had enough combined incomes there because they're combining a household. Right. So it's not that these people are horrible by any means.
No.
It's that FHA met them where they are and gave them a loan with a palatable monthly payment.
Which is still a win for everybody because what is the goal? The goal is homeownership. Okay, we can't go conventional.
Affordability. That's the word of the year is affordability.
Exactly.
Right? Affordability.
And even taking aside our current clients that we're working on, like just to get yourself into the market. Oh gosh, hang on.
Technical difficulties.
Hang on, my Adobe Flash something or other. I'm like, how you doing that now? Just to be able to get into the market right now, I think is key for people to understand, like, you don't have to be, having all eyes on conventional with your first go around. If you come in at FHA and you reach out to Dan and you say, here's what I'm able to make. Here's what I believe I can afford. Here's how much debt I have. Yep. I think you're going to be able to help me get a loan for a house at $425,000. What do you think? And then you say, yes, please. Right. I mean,
and that's the thing is FHA has a higher debt to income ratio threshold. So typically I can get them into a little more house going FHA.
Right.
But it's a little more lenient that way.
Right. And the FHA limit is what, for?
Yeah. So right now it's 472,030.
That's significant.
Yeah. So really, if you're doing 3.5% down, you can buy just about around 490 for a purchase price.
Would you say 472,330?
Yes, 472,030.
Oh, 30. Sorry. Oh,
yeah, so $472,030.
Love it. I love it.
Percentage. Yeah, there you go.
Yeah. Let me check my notes.
So just to be clear, that's the max that you can borrow. So that's your maximum loan amount. Okay. Yeah. So What I'm saying is if you're doing a standard 3.5% down, which most people do with FHA, then you're around 490 purchase price at a cap right now. You can always do more down above that. You know, if you had $100,000, but you had kind of not so great credit, you could go and then buy a $572,000 house. You see what I'm saying?
And then get yourself down to that.
Exactly.
Yeah. And the rates tend to be, you know, and I was going to ask you this. I'm looking at my notes. So is there an FHA calculator?
Yeah. So you can go, my website has one. You can go to my website, which is home loans with an S, Bakersfield.com. Yep. There you go.
Hang on. Let me put it in there. Home loans. Again?
Yep. Home loans, Bakersfield.com. And so you can go there and I have calculators there where you can kind of take a generalized look at things.
And what's the calculator going to tell me? What do I need to tell the calculator? What I make?
Sure. Yep. Well, so the calculator is just going to be something where you throw in the purchase price, you throw in that you're going to go FHA, 3.5% down, and it's going to give you a generalized kind of monthly payment like outlook, right? Okay. So other than that,
PMI,
like
with PMI or no?
Yeah, with PMI. Yep.
Okay. Well, that's correct. Good. That's good. That helps eliminate a lot of question marks.
Exactly. You know, and another way that like we really eliminate the question marks too is what people don't realize is most mortgage lenders these days like are getting on board with this. I've been doing it for a while, but you know, more and more are getting on board with this. We're not hard pulling credit at pre-qualification anymore. Okay. The reason for that is credit reports like tripled in price the last couple of years. Like it's like over $80 or something like that to pull a hard credit pull. Why? Anymore. They added all this new data and it trended credit and things like that. You can see like how much they paid versus their minimum each month. And there's all this extra data in there now. But anyway, so the idea there is like, you know, we're not just hemorrhaging money, pulling hard credit at $80 a pop, you know, 3 or 4 times a day per loan officer. I mean, you know, it'd be insanely expensive. So what we do is we do soft credit pulls. So what I'm getting at is if people want to find out where they actually are, there really isn't even any skin in the game anymore, except the 10 to 15 minutes to fill out the application on my website.
Oh, nice.
I'll pull it over, run everything, get in contact with them. Hey, here's what you're looking at. Here's what your monthly payment's going to be. It's accurate because I've actually seen what your credit looks like, even though it's a soft pull, right? So I can give people the information so they can not make an emotional decision, but they can make an informed decision with real numbers.
Yes, because there's nothing worse. I'm not doing my job. I'm not doing my clients a service. If I, you know, don't know A, what you're qualified for, we probably aren't even out there looking. But B, if you are told that you can afford something and then we're looking at the way wrong price point and we get to the, you know, down to the nuts and bolts and we realize like, Mayday, you can't afford this house. Like,
well, and heaven forbid you find something that makes your heart go like this and you're like, oh, and then you're like, oh, but sorry. Now Dan has to be the bearer of bad news. You know?
Yeah. Here, go talk to Dan. No, I'm like, it's
always better to just know it right off the bat. Like go in with the lender right away, apply, get that part out of the way. Then we have a running system file forever.
And that goes with the search, right? Because everybody's searching on their phone. I mean, like 45% of all buyers are already looking on their phone. And what do? They put in their parameters. Oh, let me look under 500. Doesn't mean they can afford 500. They don't even know. Right. They're just like, let me see what I can get for 500,000. Well, why don't you make sure you can afford the 500,000 and then maybe you can go above 500,000.
Well, and with your example right there, what if they have to go FHA and they're looking at 500,000 and I'm like, hey, but you're capped at 490 because the loan limit.
Right.
So, you know, things like that, they want to make sure that they're aware of as well.
Yes. Very good information, Dan. Hang on. Let me check my notes. Okay. Oh, we covered everything on my notes. How about yours?
So let's see. Okay. Here's another thought we can talk about. Here, I'm going to share my screen again.
All right.
So another reason that you would pick conventional over FHA.
Okay. Besides the PMI.
So another reason is the loan limits. So let's talk about, conventional loan limits are $726,200.
Right.
Okay. Significantly more, right? So if you are looking in more of that range, then you're not even really thinking about FHA unless you got a significant amount of money down.
Right.
So that's another reason why you would be going FHA versus conventional or the other way, is because if your loan amount is high, you got to go conventional for the most part, probably anyway.
Right.
Depending on your circumstances, of course. If you got money coming out of your ears, well, okay, we can probably make that happen for you, right?
Let me find you something.
So, but that's one thing for sure too, is if now, you know what, one other thing I'd probably want to mention on conventional is mortgage insurance, right? So there is mortgage insurance on conventional, but with conventional, mortgage insurance is based on all the factors of the loan. Okay. So if you're putting 10% down, for example, your mortgage insurance is going to be less than if you put 5% down, right? Your risk is less. So you're paying for less risk alleviation.
That number.
Right. So that's another thing where, you would want to choose where you go. Because if you have 20% down, you're going to want to go conventional all day long if you can make it happen, because you'll have no mortgage insurance at all.
20% is the marker that you want to shoot for with a conventional. So you don't even have to have the PMI conversation.
But you don't have to do 20% down. That is a misconception. You can go all the way to 3% down for a first-time home buyer. If you've owned a home before or within the last 3 years, then you're 5% at least on conventional.
Explain what you just said, because I know what you just said, but you can get an FHA loan as a first-time home buyer, even if you've already bought a home. Say that again.
Correct. Yeah, you can get FHA loans even if you're not a first-time home buyer. Correct.
Isn't that amazing? Isn't that amazing? Like it's like you hit the reset button.
Yep. So with a first-time home buyer on a conventional loan, the 3% option is only for first-time home buyers. Okay. So if you've owned a home in the last 3 years, then you're going to be at 5% down as a minimum.
Okay. Well, that's still reasonable.
Yeah, still great. Yeah, exactly. Still great.
I'm like, am I missing something? That's still pretty good.
Okay, here's a trivia question. Ready?
Oh, no.
Okay. Can you have 2 FHA loans at once?
Okay, now I know the answer for a VA.
So if you own a home with an FHA loan on it, can you buy another one with an FHA loan on it?
I'm going to say yes. Yes.
What do you think? Yeah.
Yes.
Yes, you can. Now, here's the thing. Not all the time.
Yes, maybe. Yes, kind of.
Extenuating circumstances let you do that. So let's say for
a life event.
Let's say we have a divorcing couple. Okay. The wife is staying in the home that they've been living in all along with their FHA loan. The husband, the ex-husband, needs to go and buy on his own, and he wants to use an FHA loan, but he's still on this mortgage because they're not at a place where they can refinance it. So he can then go and get his own FHA loan, and he can technically have 2 FHA loans. So there's certain extenuating circumstances where that works.
Okay.
The reason why they have those rules is because FHA is not trying to be your lender of choice if you are trying to build an investment portfolio. So they're squashing you buying multiple properties because they don't want you to use FHA to buy multiple properties.
But obviously they know, stuff happens, and, if you have to, you have to, but they don't want your entire, like you said, like all the 17 homes that you own to be FHA.
Correct. That's not what it's there for. It's there to help people get into homes, not to, pad your wallet with investment properties. You know what I mean? So speaking of investment properties, I got one more thing we could do there.
Do it.
FHA would be another interesting thing to consider if you're wanting to buy a 4-plex or a 3-plex or a duplex or something.
Dan. Tell me all the things.
So if you are looking to buy one, you can buy up to a 4-plex, 1 through 4. You can buy a 4-plex for 3.5% down with FHA. Okay. The caveat is you gotta live in it.
You gotta live in one of them.
You gotta live in one of them. So it's kind of a needle in a haystack, because you gotta find one that's got a vacant unit that you can live in, and you gotta want to live in it, right?
Yeah, you gotta want to live in it.
But I have done plenty of them, and with people that are in the right stage of life that are interested in that sort of thing, they can buy one and with very little down, if you think about it, and then be able to rent the other units. Very interesting.
Isn't it? Doesn't somebody call that? Is that the one that they call house hacking? Is that
kind of. Yeah. Yep. Yeah.
Paying attention.
Anyway,
Yes. No, I think it's great. I've covered all of my notes. How about you and yours?
Yeah, I think so. FHA, you're going to be 580 credit scores and up. Ultimately, you're going to want to be, for your better loan is going to be 620 and up. And then honestly, 640 and up is your better interest rate. But 580 to 620 is kind of a funky loan. It's a little bit harder to get. It's not always guaranteed. I don't know. Yeah. You can try it, but it's not great.
580 is what the minimum is for FHA?
Yep. Oof. Now, you can go down to 500 with certain lenders in certain circumstances with 10% down, but
yeah, you're going to have to pay.
It doesn't happen very often. And then conventional, you have to have at least a 620. So that's where you're at for 620. So 620 and up for conventional.
Right on.
Now, with when you get down to that range, the mortgage insurance gets pretty out of control. Oh. So you're in that case,
really, translation, you probably shouldn't be buying a house. Right?
Probably reserved for folks that have a good amount of money down, so they're not doing any mortgage insurance at all. In that case, they just would only have a high rate.
Yeah.
Because of being a 620 credit score. Okay.
So if you're in the 500s, I don't know that might be the top priority is to be buying a house. Might need to clean up some of that a little bit.
At that point, like we typically send people to credit repair, have them fix some of their issues, get their scores bumped up.
Yeah.
And then they get a better loan anyway, and they save money. So on their mortgage, right? So that's kind of where I come in, is I help with all of those different things, right? So wherever somebody's at, I either go to, you either go to credit repair, or you're gonna, we're gonna pay off some cards, or get an authorized user card or something like that, or all kinds of little tricks, to help get our scores boosted up. Sometimes they don't even know that there's issues on their credit. Like I've had people like, I have no idea what that is. What is that? And then I find out that they're a victim of identity theft or something. Oh. So I always go over the credit reports for people too, just in case.
Well, and then something just flew through my brain. Hang on, it'll come back. We were talking about for crying out loud! You were just talking about the credit, cleaning up the credit. So this is why you have to talk to somebody who does this for a living all day, every day, because when you're just jumping onto, or when people are just jumping onto Credit Karma and being like, well, Credit Karma said I'm at 627, and truth be told, you're probably not. This is why you got to talk to a professional. I think people get, nervous when they talk to somebody like yourself, not that you're intimidating or not able to be talked to easily. It's that they think like, what's that going to look like? Then I don't know, maybe they feel like they're airing their dirty laundry or something. Like, have you experienced that? Like, what do you think that is? How do we get people over that and just reach out?
Yeah, I think it's a fear of rejection. So people are they're just worried, like they're going to like get their heart involved in it. And I'm going to come and I'm going to say, nope, you're not going to. And then they're going to kind of think back of it. But it's never like that with me. It's like, here's the plan.
Right.
Like, if you start now, like the adult thing to do, hashtag adulting, right? The hashtag adulting thing to do is to start now, make a plan, and get on the road to owning a home now, versus doing that in 6 months, and then you're 6 months out on that, right? You see what I'm saying? Like, do it now. Don't worry about the rejection. That's not how I ever phrase it. I'm just like, hey, here's what you're at. Here's where you're at. Here's how I can come alongside you and show you ways to fix your credit. I mean, we can even get down to the brass tacks of like, paying this card off won't budge your score at all. Paying this one will.
Right.
So that you can use your money where it matters, where it moves the needle.
Yes. I think the best way to look at that is like, to your point, like, hashtag adulting, but then also like you're being given the right tools. Like, no, don't go pay off that if you don't have to. Hit the medical from whatever, 1994 versus, paying off Macy's. Like, I don't know if that's the right decision. And believe me, they ask, and I'm like, not my wheelhouse. Talk to an expert. But really, that's why, because you don't need to go poking a bear on your credit if you don't have to. If you can still clean up some of the other ones, and then, and even if it's not cleaning up, even if it's just like, we need a consistent amount of paychecks. Like you just started this job 5 minutes ago. We need some paychecks under your belt, whatever it is, you're walking away from the conversation or from, the email exchange with tools of like, okay, so I do these things for the next 3 or 4 months. And then in 6 months, we can actually have a number of a house that we're going to be shopping for. Like it just seems, yeah, I mean, kind of basic for you and I, because we do it all day, #adulting, but like it is just walking through the right tools.
Yeah, start the process, get started.
Yeah.
That's the thing. You know, don't disqualify yourself.
Yes.
And talk to us, see what we can do.
Yeah.
You never know.
You never know.
I got a few tricks up my sleeve, you know, most lenders do. You know, we do this every day, all weekend too. Yes. So, you know, we'll help you, and we'll have a
Lord for the weekend texts and calls.
Yeah. You know, we'll have a little fun doing it at the same time. Why not?
I love it. Thank you so much, Dan. No, I appreciate it. You've hit all my markers and then some. And I think this time hopefully has been very valuable for anybody that's watching. You know, here, let me make sure everybody knows how to reach out to you. There's your number, 342-9381.
Give me a ring, shoot me a text, head to homeloansbakersfield.com. You can apply online in minutes, you know, at the middle of the night, it doesn't matter. You can just jump on there and do an application. And when
they go there, that notifies you, right? Like
correct. Yeah, I get all kinds of dings and, you know,
as we heard.
Yep. Even on my phone, I get all the little, I have an app for it too, you know, so
love it.
You know, I get notified that I have a new one to work on. I pull it over to my side of my system. And that's also my document portal too. So when you're done with the application, it'll actually tell you right away what documents are needed. So pay stubs, bank statement, you know, the normal mortgage related stuff that we need. Right. It'll tell you the list out the documents are needed, and you just upload them to the website.
Right.
So you don't even have to come to my office. You know, I can, you know, the whole mortgage industry is going all in with tech. So it's going to be soon where we're actually signing our documents at the end, like our final closing docs. We're going to be signing that like this on FaceTime with a notary.
Oosh.
Electronic signing. Oh, so she's verifying your ID because she's looking at your ID and she's like, oh, that's the person on the screen right there.
Wow. Okay.
And then they'll let you click through all of your signatures. That's already happening in many, many other states. Like we're one of the last holdouts, in fact, in California.
We're so special.
It's coming for us too, where you're going to do so much of this online. But I mean, you know, it saves the paper, saves the gas, saves the time. You know, you can do it in the middle of the night. You can do it after work. You can do it when it works for you, right? Instead of on my, you know, 8 to 5 schedule or whatever, you know, even though that's not my schedule at all. Yeah. As you know, we were talking last night at 9:30 at night. So, you know, but we got the offer sent out, you know, that's how we roll.
Oh, so. I love it. Thank you so much, Dan. I think you just dropped a ton of knowledge on people that are curious, like, well, how does this work? So yeah, I think everybody needs to reach out to you.
Look forward to it.
Yay. Thank you so much. And again, let me put your number up there. Worst case, just call in and be like, what do I do next, Dan?
There you go.
442-9381. Thank you so much for joining me.
Thank you.
I will see you around town, and you and I will be communicating a bunch. But
that's right. Let's go.
All right. Hang tight, Dan. You and I will chat when this is done. Okay. But for those of you watching, yes, thank you. Dan, again, this is Dan Ardis with San Joaquin Valley Mortgage, and we are super excited. We thank you so much for watching. We will see you around town.
Bye.